Hi all, welcome to Scientific Investing and wish all of you a very happy Deepavali. So from a long time, there was one request which was pending is to make a video on the overall market and how we should act in current market. So if you remember last time जब हमने market का video बनाया था वो last year I think जून से लेके September 2024 के बीच में बनाया था. And we had highlighted caution, highlighting the reasons of a margin top out along with valuation. And last 1 year, as you have seen, market has not been great. So अगर आप देखोगे सितंबर में सबसे पहले तो पोर्टफोलियोज टॉप आउट करने लगे एंड दैट्स अ टिपिकल नेचर ऑफ मार्केट. मार्केट विड्थ ब्रेड्थ पहले कमजोर होता है, इंडिविजुअल पोर्टफोलियोज पहले कमजोर होते हैं, स्मॉलर कंपनियां पहले टूटती हैं और फिर धीरे धीरे जाके इंडाइसेस भी टूटते हैं. एंड दैट इज व्हाट हैपेंड बिटवीन सितंबर टू दिसंबर जनवरी एंड देन सिंस देन वी हैव बीन अ करेक्टिव मार्केट. नाउ अगर आज के डेट में देखें तो सी फ्यू थिंग्स हैव हैपेंड एंड हैपनिंग. सबसे पहले तो वी हैव गॉन थ्रू 1 year ऑफ करेक्शन. सो 1 साल का करेक्शन हो चुका है क्योंकि when market corrects, the corrections are not only price based corrections. There are three ways in which market corrects. एक तो प्राइस घटता है, 20,000 का इंडेक्स 18,000 पे आ जाता है, 200 का स्टॉक 150 पे आ जाता है. So one is your price based correction. Second is your time based correction. The more market spends time at the same level, that is a correction also because कंपनीज परफॉर्म करती रहती हैं, इंडेक्सेस परफॉर्म करते रहते हैं, whether they grow at 5%, 7%, 8% until they are degrowing, which usually doesn't happen. At least at a consolidated index level you will find some level of growth. It might be 5%, it might be 15%. So at the same price, when you are growing with 10% annually, actually you have become 10% cheaper without a price movement on the upper side, which is basically your time correction, which happens through the EPS growth rate. So you have to look at both price correction as well as time correction. अब अगर आप पिछले 1 साल में देखोगे एंड यू कैन पिक डिफरेंट इंडाइसेस, यू कैन पिक अ निफ्टी, यू कैन पिक अ निफ्टी 500, you can pick a small cap index, mid cap index. What has happened? All of these have seen 1 year of time correction. All of them have shown some EPS growth. Some have shown higher, some have shown lesser. And from the peak of last year, some are maybe 2% down or close to there, like how Nifty has almost come close. And some indices, like small cap indices, are still down from the peak by maybe 6, 7, 8%. So the question is now how long this can last and what can happen in next 6 months, 12 months, and when we should expect the next bull market. This is the typical question everybody has. Again, I would repeat, it's a probabilistic exercise. It's not exercise of making any binary prediction. Now, if you look at history of corrections, mostly in last 25 years, the corrections would have lasted from 1 year to 2.5 years. Usually 2.5 years is a long time. That is by price. Also in term that is by time, and in terms of price, for a Nifty, a 15-20% correction is a very good correction. And for a small cap index, take a double, somewhere between 25 to 35% is a good correction, having seen that kind of drawdown. And in March, we did see that drawdown. But all of these are more technical way of looking data. Why during this 2 years, 1 to 2.5 years of correction, and why with 15-20% of correction on Nifty, and why with 25 to 35% correction on small cap we make bottom? The fundamental reason is valuations become attractive. So if you look at historically data, and Nifty is a much more stable index. So when Nifty goes below 20, it starts becoming attractive. See, 19 to 22, 23 is a zone where Nifty most of the times will be in fair zone, depending on the growth rate. If there is a 5% growth rate, 20 could be costly, but if it's a 12, 13% growth rate, a 21, 22 P is reasonable. Only when you come down to 16, 17, which happens rarely, or if you go up to 26, 27 at a lower growth rate or the growth rate slowing down, then It's a extreme situation. So with that, if your Nifty is growing at 10, 11% and comes down to, 19 kind of P, that's a very, very fair value. And historically, if you see, most of the time, if you exclude the extraordinary situations like 2008 or a COVID, 19p, 18p, these are very, very decent numbers to take an entry, or with a time correction with some good results expected. This is what again happened in March 2025, and we do cover a lot of these things. Our monthly insights, market monthly sessions, which we do in practitioner, where we walk through the Simba data and we can do it. So we had also highlighted in that particular month when this was happening. I think in Nifty right now, and most of the times we want extreme news because it is very exciting. A bull market will start, or from a 50% correction will come, because you create sensation, and sensation attracts eyeballs. But I will have to disappoint you that currently I don't think we are in any kind of sensation zone. Last year, from a overvaluation perspective, we were it was always told that retail investors don't have that kind of institutional capability. Institutions have huge research team. Technology is changing that. The kind of AI tools which are there in the market, it's as good as having a team of 4 or 5 analysts with you if you know how to use it well. So a lot of these companies in 2 to 3 hours, you can have the whole summary of company, who is doing what, who is expected to grow at what rate. Just leverage the technology. So another thing, we are doing an offline workshop on how to use artificial intelligence tools for investing, and 70 to 80% of the seats are blocked. I think Mumbai is already full. We don't have seats. Delhi, we have 2 seats left. Bangalore, we have 7 seats left. And Chennai, we have 4, 5 seats left. Kolkata is the only city where we still have some 15, 20 seats left. So if you really want to understand how to leverage AI in doing the research, being more productive, you can attend the workshop, and you will get 4 months of practitioner membership extra. Also, those who want the practitioner membership, there is a Deepavali discount running. You can get it at additional discount. But right now, I think we are in a market where neither we have to be very bullish and nor we have to be very bearish. I think we have come somewhere in the fair zone. If you look at the recent last 4 quarters of Nifty 50 EPS growth rate, and the way I measure Nifty is very simple, because I do my own calculation company wise. So I just take the top 50 companies by market cap, and I look at the sum of last 4 quarters of PAT, and I try to compare with previous 4 quarters of PAT. You will see Nifty is growing at around 10%. Now, for a 10% kind of growth rate, like, I don't know if you know about DCF, discounted cash flow valuation technique. If you apply similar kind of principle, give this kind of growth rate for a few years and give a terminal growth rate of 4, 5% and all, you try to value it, you will find 20p is a very reasonable P. It's not overvalued, it's not undervalued, it's a fair estimate. That is what I will call it, a fair market. So given it is growing at that kind of rate, given the valuations came down to some 19.5, and we are in 22 zone, I think we are somewhere in the fair range until we can continue with this 10% kind of growth rate. The same fair range will be maintained. So, 10% up minus plus minus corrections can always happen. But the more you go into correction, ideally, the people who are pure traders, they get scared and they exit. But I believe more in blending fundamental and technical. So I find those zones more zones of attractiveness. Because see, it's not that always you will get a 2 years of perfect bull market where you will make 60, 70%. Sometimes lesser money is also made. So my sense is currently Nifty, the way it is placed, you might have a run up here again from here also. But if you see logically, I think we are in the fair zone, and this fair zone will get maintained by the EPS movement. So if your EPS movement is moving by 10, 12%, YOY EPS growth rate, you should, at this valuation, you should expect similar kind of return. So if the market in next 1 year is giving an opportunity where Nifty is growing by 20%, but the EPS growth rate is 10%, I will consider that as extra return. I would like to book my profits. That is how you have to take. So every indices, you have to take it accordingly. If you look at mid cap index is growing at 15%, but mid cap index PE is around 30. So the question is how much again valuation multiple you would like to give to a mid cap index. My sense is still you are growing at 15% kind of growth rate. Anything below 26, 25, it starts becoming attractive. But right now we are at 30. So mid cap still mid caps. A small cap, the problem is small cap growth rate has not been great and valuation is also on the higher side. So every indices has to be looked from its specific perspective, fundamentals in terms of valuation, earnings growth rate, and then we should look. The other question is how long it can run. So I will again highlight that I'm not expecting anything much as of now because see a very good like what you saw in a 2023 to 24 bull run, you started at a much lower valuation base, like 17p, 18p. And then you had a margin expansion led double digit revenue led growth, which gave you a 20% EPS growth rate. So that is why 2 years, 20%, 20%, 40%, and then your EPC, your PEs from 17, 18 stretched to 30, 35. You got a much higher growth rate of, 25, 30% CAGR. But if your current P itself is on Nifty, let's say is 22, or a small cap, mid cap is 25 or 28, 29. Still, if you are getting a 15% growth rate, still let's say the P's will stretch to 35, 36. You will not make that kind of money. And here the money will be how much you will make will be more dependent on that extra re-rating risk apart from this 15% kind of EPS growth rate. So my suggestion would be don't build any major expectation apart from 10 to 15% kind of return growth, which can happen by maintaining same kind of multiples with similar kind of growth. And see, whatever statement we make in 1 or 2 quarter, things change. So if the growth can be higher than this, maybe fueled by the GST initiatives, or if the growth could be lower than this, maybe worsened by what is happening in the geopolitics, the things will change. But ultimately, you have to track the growth number, you have to track the multiple, and you have to track the charts and time correction, and then you need to take a decision. So again, summarize everything. I don't think we are in any kind of extreme market where I need to make any kind of extreme caution or extreme bullishness that go all in. These are times where if you do bottom up investing, you will still find enough attractive stocks available in the market. The only thing is they may not perform as per expectation because the broader market is still consolidating. And when the broader market consolidates in the portfolio, 10 stocks will go up, 10 stocks will go down. Net net, we won't move much. And that is what is happening. But whenever the bull market starts, if we have purchased things which are attractive, they will reach most of them will reach their true value. And the second thing is in the long run, stocks run on their own EPS. I mean, on a 4 to 5 year basis, stocks will run more on their EPS capability. And somewhere they will become independent of the market direction. But in short term, yeah, they are linked to market direction. So what I do in these kind of markets is the caution time was last year. And I think what we saw in terms of market bottom in March, a lot of things were attractive and still things keep becoming attractive. But what was attractive in March may not be attractive again. Something else might be attractive. My way of handling such market is do a staggered buying. One thing, what I'm not doing, I'm not chasing any kind of breakout trades and all. I'm not chasing breakout investments because these are the things which will hurt you, and every 10% fall is going to hurt you. And there will be more and more false breakouts than successful breakouts. So here I am using technical analysis more for bottom fishing than for breakouts. And how I'm using technical analysis, my primary analysis in this market remains fundamental analysis where I'm trying to find value and then I'm trying to time that value at better support levels. See, breakout is only okay for me when the valuations are favorable. If the valuations are not favorable, then I'm not looking at breakouts. I'm looking more at the lower end, the intermediate corrections every 2, 3 months when it is happening. Those are the levels. And I'm not buying in one go, I'm buying in a very staggered manner because the idea is to go through this time correction, buy in a staggered manner, slowly accumulate. so that you bear major shocks, you go through, manage the time correction through better asset allocation, still by maintaining some liquid fund or cash or gold or whatever, or REITs, InvITs, but the idea is to go through another, maybe assuming pain may last for 5, 6, 7 months or 1 year before you see one proper bull market emerging, as markets become more attractive by price or time correction. At a broader market level, I'm still not very positive, because if you look at my Simba scores, and we generate these scores on a monthly basis, though we cover daily level, whatever is coming in, ghumega machayega, some breakouts and all reversals. This tells still the market breadth compared to Nifty in terms of a momentum is very subdued. So it's the Nifty and the indices and the bigger stocks which are doing relatively better compared to smaller stocks, whereas bulk of our portfolios will be more and more smaller stocks. So until unless that breadth changes, I don't see anything significant happening. And already I covered most of the things. So I hope it gave you a consolidated view on the market. And anything more than that, if I find something interesting, I will keep updating you. Once again, a very happy Diwali to all of you and your family. Thank you.